Tanner. So just a quick introduction. A lot of you guys, if you've sat on these before, or if you've met with me, you know who I am. My name's Austin. I'm one of the advisors here with Capital Financial Planners. I'm a CFP, joined by Neil, who most of you should know, been giving presentations for us for a long time, and has probably worked with a lot of you as well.
Yep. So my name's Neil, if you don't know, and I got to update my years of experience, Austin. I've been doing this since 2005, so that would put me at 18 years. Holy mackerel.
Getting close to 20.
Holy mackerel. Yeah. So I'm getting on the big 2-0 in terms of being a financial planner. Cool. All right.
Well,
So we've got people still kind of climbing in, but
yep.
I think it's time.
Sure. So just a couple housekeeping things. One is we will be sending out a recording of this to anyone who signed up. So feel free to watch that, share that, whatever you want to do there. Also, we'll be answering some questions at the end. So if you have questions throughout the presentation, there's a Q&A box where you can type in your questions, and we may be able to address those as we go along, but likely we'll catch those at the end here. So just a couple things there. So let's go ahead and get started. This presentation or this commentary is going to be maybe a little bit different than our ones in the past. There are a lot of things going on in the market right now, and we want to dissect not just the positives or the negatives, but kind of give you guys a picture of both forces that are at work in the market right now. And so we're going to jump back and forth a little bit and talk about some of the positive things that are going on, some of the headwinds that the market faces, and what we can maybe expect throughout the rest of the year. So what I want to start with is some of the good news. Something that we've been talking about, if you've been sitting on these commentaries, is we have been stressing the point of inflation, interest rates, and how that has been impacting the economy in different ways. That's been the big story of this year. So the first piece of positive news that we've seen here is CPI, the Consumer Price Index, or the measure of inflation, has declined every month since June of last year. Okay, and we've continued that trend. So we're down to 5% year over year was the last reading in March. Now, to go along with that, there's all kinds of pieces that play into inflation or the consumer price index. There's food prices, energy, vehicles, housing, right? And one of the stickier components of inflation, or something that's just been having a really tough time coming down or giving any leeway, has been housing, right? And so one of the things that we're most excited to see in these last few months is finally housing prices are starting to stabilize, and we're even seeing rent prices start to come down. We've seen the first year-over-year decrease in rent prices since 2020. So that's been good news in those inflation data points. Now, a big reason for that, one of the biggest problems with housing is there just isn't enough supply, right? When there's demand outstripping supply, that's when you're going to see prices continue to climb. Well, we're seeing housing starts and completions continue to climb and kind of accelerate through this year. So that's all good news as we are looking forward and seeing what's contributing to this decline in inflation, and is it sustainable? Okay. Now, as I said, we're going to go back and forth a little bit. So that's the good news, but there are certain things that we're looking at coming forward that are, we could say, room for concern, or that are holding us up a little bit.
Thanks, Austin. So those are positive developments. As we start to look closer at the stock market, which is a lot of what we follow and we deal with as financial advisors, right? the first thing that we got to look at is valuations, right? And when it comes to valuations, the term PE ratio gets tossed around. What does that mean? So PE ratio actually means the price you're paying for a year's worth of earnings. Okay. So let's put that in an example, right? If a company has 17 times earnings, let's just say a company earns $100,000 in a year, that means you're paying $1.7 million to own that business, right? And at some point, these valuations get very frothy, and that's when markets tend to correct. We're seeing the US markets right now valued at close to 18 times earnings. It's not a major overshot in terms of historicals, but it's still not, let's say, a bargain, okay? And you can see what happened there in the tech bubble, right? We got way overvalued, way above 20. That corrected. We saw a similar scenario there in 21. We got over 20. Then we got a big correction. We're down about 15% in terms of just stock market drops since 22 began. And we've seen some of this valuation come down in terms of price to earnings ratio. We're still not seeing this as necessarily, like I said, a bargain. Where we're starting to see some of the bargains is overseas, where you see developed trading at 13 and then emerging markets trading at 12. Those seem a lot more attractively valued to us right now, which is where we're beginning to kind of build more of a position in our portfolio. We're not necessarily that bullish necessarily on US stocks right now, right? But it's something that we're kind of following the trends on. Where we're actually putting more money to work in the US markets are on indexes that have low PE ratios attributed to them. So one of the investments you might see in your portfolios today is an investment called SPGP, which stands for the S&P 500 Growth at a Reasonable Price, GARP, G-A-R-P, right? That trades around 12 in terms of PE ratio. So we think in a high interest rate environment, you want to be leaning more towards lower price to earnings ratio, not overpaying for a company's profits. When you have, investments basically like treasuries paying a lot higher interest rates, that's an environment where you do not want to overpay for a company's earnings. So that's kind of what we're seeing right now, and the justification for what we're doing inside of our portfolios. Next is going to be what we're seeing across in the business cycle in terms of just sentiment. We're seeing very low consumer sentiment in terms of what current conditions are, what the expectations are. Generally speaking, you see this type of low sentiment in recessions. We go back to 1980. That was a recession, actually double recession during that period. 1990 as well. Then, of course, you got 2008, right? Was, the largest recession in our lifetimes. So this is a concern. But on the flip side, you could also look at this from a contrarian angle and look at this as a potential signal that we're approaching some of the lower levels in sentiment. That's usually when the markets begin to turn around. Now, I'm not saying that that's within the next few months, but certainly if we start to hit these levels and stick at a lower consumer sentiment, it does mean that we're grinding towards a light at the end of the tunnel, okay? But right now, we're obviously still kind of stuck in this cautious wait and see area, and that's where we've currently positioned our portfolios in. So the last slide we'll just kind of talk about in terms of the cautiousness that we're looking at is the business cycle in terms of small businesses. Small businesses are hunkering down right now. The word recession has probably been tossed out the most it's ever had in the last couple decades. I mean, this has been an anticipated slowdown. And really what that's done is with the inflation that we've had is it's caused the Fed to tighten more. As the Fed tightens more, it's creating more stresses on smaller banks. All of this essentially creates more tightening conditions around loans. When loans get tightened down, that is more difficult scenarios for small businesses to expand, hire, those types of things. So that leads to a more restrictive condition that we eventually think will pan out over the course of this summer, which essentially leads us to what could be a milder recession taking place.
Yeah.
So, Austin, do you got some other color around kind of these slides that we're putting up here?
Yeah, well, and speaking of loans, a big question that a lot of people are asking us about is the U.S. debt ceiling, right? Let's talk about our our government's loans. So there's going to be continued conversation around this throughout the summer, right? We're approaching this time when the government has to make a decision on whether to raise or suspend the debt ceiling before they start defaulting on debt. Now, there's all kinds of speculation around this. Both sides of the aisle use this scenario every time we approach it as means to, pass their agenda, right? Whatever that agenda is, they use it as a bargaining chip. But I think what we have to remember, what's important to remember is at the end of the day, no politician on either side of the aisle wants the US to default on their debt, right? And what has happened every time in the past is something has given and we've been able to avoid this issue. So especially for federal employees that we work with, some of these extreme measures, one of them is not reinvesting the G fund, right? That the government gets to, and that's caused a lot of questions from people. Now, in the past, historically, every time everybody's been made whole there, right? But it's cause for concern. And so we're going to keep our eye on this. There's nothing we can say as far as certainty on when this is going to happen or resolve at this point, but it's something we wanted to address and know that we're keeping our eye on that as well as we move into the summer.
And one point to make, right, and I think we could say this is we expect this in the list of worries to add to a volatile summer. Okay, do we expect essentially the U.S. to default on their debt? No. Do we expect a showdown in Congress till the end, leading to anxiety in the markets? Yes. Okay, and that's essentially what we're kind of bracing for, and what we're bracing for in our investment portfolios too.
Yeah, and that theme will come up a couple more times in this commentary, just in the fact that this summer could be a volatile time. There's just so many things coming to a point right now that we're not anticipating any sort of major market movement, but there's enough happening right now that we could see some volatility into the summer. And one of the things pointing to that, okay, there's a culmination of indexes or indices that have been made into a grouping called the leading economic indicators. Now, if we look back historically and we're tracking these indicators as they move over time, they've been a pretty decent predictor of recessions. Okay, so if we see any time that these indicators are pointing negative, under zero here, and then we see the gray shaded areas are past recessions. So we see really any time since the 1970s that these indicators have been negative, they have predicted a recession. And we see right now we're looking at we're in the red. Okay, and we haven't seen the recession happen yet, but you're starting to hear, and you have been all year. And if you've sat on any of these commentaries, like this shouldn't be a surprise to you. Okay. We've talked about recessions over and over. We're talking about it in our meetings. If you're a client of ours and you're meeting with us. And I think one of the things that we want to focus on, and that Neil's going to talk about here in a second, is that not when we hear the word recession right now, what everybody relates to is this one, right? The Great Recession of 08, 09 into 2010. And the point we want to get across is not every recession is that extreme or that way.
Right. And this slide articulates this really well. All right. So this slide is actually put together by Morningstar's behavioral research. And what essentially this gauges is it gauges what investors expect to lose in their investment accounts during a recession. And so when this poll was taken, the average expected loss by investors is 22%. So essentially what Morningstar did was they ran data going back to World War II and looking at all recessions and seeing what the average loss was during the recessionary period. Now, we're not talking about before the recession occurred, right? Because a lot of times markets drop ahead of a recession, all right? And keep in mind, we've been sliding for 16, 17 months. We're down 15% on the stock market since 2022 began, okay? We're just talking about that official kind of envelope of time around that recession. So the average drop going back to all these recessions is an astounding number that even is difficult to believe. It's -3%. And the reason why is you have a group of recessions basically here on the right, 81, 1960, 1990, 1988, 53, that essentially the market was positive in, okay? And then you have a group of recessions kind of there in the middle where the market was down between 5 to call it 15%, right? The only recession where there was such a strong downward movement in the stock market during this entire 70-year span was essentially the last major recession we went through, which was 07, right? This is when the market moved down 40%. And this is what's so fresh on everyone's minds, mine included, right? Because essentially my career began in 05. First 2 years of my career was absolute chaos, okay? So it's really, really helpful to see these figures and understand what we're talking about when we're talking about a recession, right? Which we may be sliding into here in the next couple of months, you know. So these figures represent a average figure. So now, Austin, let's now look a little bit closer on the hood. So this is Morningstar again, and it's diving further into that average 3% drop, right? So let's pick out some of these recessions, right? So obviously we have 07 where we moved down 38% during the recession. That recession lasted 18 months, right? Leading up to that recession, we saw a 7.9% climb 12 months before 2007. So if you rewind the tape, what happens before the 2007 recession? Well, the Fed raises rates exactly like it did here. It actually gets out to 5.25%. It stops raising rates in 06. And from 2006 to 2007, the market climbs another, well, what this graph says, 8%, right? Coast is clear. No, not exactly, right? The market folds over, then does that massive drop of 40%, okay? That's not like the situation we're seeing today. Again, we're down 15% over the last 17 months, so we didn't see a climb here, okay? Let's rewind the tape a little further. Let's look at March 2001. So March 2001 is a recession that lasts for a extended time period. You got almost a 30-month kind of lull in the markets there. In March of 2001, we got kind of a double whammy. We got the September 2011 terrorist attacks, followed by the tech bubble, right? Maybe not in exactly that order, but it was a double whammy, okay? In this scenario, the markets actually dropped 18.7% ahead of the recession, right? And then that recession is really not so bad. You get a 6.1% further drop from there. So this is why every recession's different, right? Some experience further drops. Sometimes that drop is ahead of the recession because that recession is so foretold that markets anticipate that way ahead of time. I would say that we're a lot more in that camp than the completely unexpected recession, let's call it, of 07, which literally wiped people out. Okay. And you can dissect all these figures, but I think the other point to this graph would be moving out 12 months after, 3 years after, 5 years after the average return that you start to see out of that recession is significantly better when you get to that 3 years after and 5 years after line. So that's essentially what we're kind of looking at in this case. And this is what we're hearing from our counterparts at LPL, as well as some of the other investment arms that we look at, which is Invesco, Spider, PIMCO, to name a few. The consensus really is around this thesis of a lot of the pain coming in prior to the recession on this one.
And I think it's important to kind of remind people what a recession, how that's defined, because I think there's kind of a common misunderstanding that a recession is like when the market is down over a period of time, like that's the recession. And from an economic perspective, like a recession is not necessarily a market event; it's an economic event. So it's caused by economic productivity going down over a quarter or 2 quarters in a row. Okay, so a lot of times, like when Neil says the market is anticipating a recession, like people are not investing as much or keeping money on the sidelines or not wanting to invest in growth in anticipation that these companies are going to start performing, in a weaker way. Yeah. And so like if we see a recession and like everyone is already anticipating that these companies are their profits are going to slow and earnings are going to slow down, like that's been anticipated for the last year and a half. And so that kind of leads into this way that if that does happen, then there shouldn't be this amount of fear in the market that we've seen like in 08, because everybody's been expecting it to happen. So yeah. I just wanted to say it because that's why, if we hear a recession, people could still be concerned about that, but that doesn't mean the market has further to fall.
Right. Yep. I think the biggest painful recessions were ones that came out of left field, right? Where you had a massive surge prior to that. And we're not seeing that type of scenario play out right now. Last slide that I'll talk about before I move it over to you, Austin, is debt ratios in terms of corporate debt. Now, when we look at the recession of 08, one of the major issues with that recession was that it affected some of the biggest and largest corporations in the United States, particularly banks and insurance companies that had major balance sheets. The implications of these companies going under, having to be propped up by the federal government, if they didn't, would essentially end the banking system potentially. That's not what we're seeing this scenario, right? Where we're actually seeing that the larger US institutions in terms of corporate debt levels are at some of their smaller levels that we've seen. We've seen a tick up on the smaller or mid companies, and that's where we're seeing some of the problems in these regional banks and things like that. But we're not seeing those issues play out in some of those bigger companies. And you could argue that these bigger companies will unfortunately be some of the benefactors of the carnage that's going on that small to mid-size. And this is how we've allocated as well our investment accounts. The broad majority of our investments are towards the large cap institutions. We've been very low in terms of our allocations towards that small and mid-size company capitalization in the market. So essentially, we're allocated towards this. And this is another reason why we don't think the contagion this go around will spread as much to that larger sector. And it may actually play the other way around, where you get the benefactors being those larger companies absorbing these small ones, which is essentially what we're seeing right now.
Yep.
Austin, anything to add to that?
No, well, I mean, you were talking about how our portfolio is allocated right now and skewed towards larger companies. And then another thing that we've been talking about lately is the fact that we have taken some risk off of the table as we head into the summer months. And, part of that is the conversation that we've had around the recession, potential implications of that. But we just said, oh, we don't expect it to be a major event. So why are we still taking some risk off the table going into the summer? And
just to be clear, right? We can be clear on what we've done is about a 10% equity risk off during the summer. Okay. On the portfolios, nothing crazy, but we just see signs pointing to that being a prudent change, and particularly seasonably, what you're going to explain here on this slide is one of those reasons as well.
Yep, exactly. Yeah. And I didn't want to cause any confusion there. We haven't made any fundamental shifts to the risk in our portfolios. Just a minor tactical move going into the summer. But one of the reasons for that is the summer tends to be weaker for stocks. There's a saying in the market that it's sell in May and go away. And the reason for that is the summer months tend to be lower performing months. Now, that's not always the case, and I'll show you a chart here that would say that, but this is one of the historical trends that we see in the market. Okay, we see May, June, August, September being some of the lowest performing months since the 1950s. If we're looking from a 6-month rolling returns perspective, May to October, historically the lowest performing here. Okay,
considerably the worst, huh?
Yeah, but on that same vein, I almost don't want to spend too much time on this because it's not something that can always be trusted, right? And when we look at sell in May over the last 10 years, this May to October rolling 6-month period has actually been fairly positive. Okay, we've seen an average of 4.6% return over this last 10 years. Now, last year, the strategy would have worked out. Okay, now with this historical trend paired with some of these other headwinds, recession talk, business earnings slowing down, things like that, that's why we think this is an okay time to take that minor shift back in risk. But at the same time, like I said at the beginning of this is going to be a conversation where we're going to give kind of both sides of the argument here. This doesn't mean that we always have a black and white way to move forward or something like that. So I always like to show things or put things in historical perspective, but also remind us that any year can be different in the market. So, and that's why it really comes into, what we're reminding people of all the time, which is kind of the psychology behind all this.
Right. And that's where we kind of say, look, at the end of the day, we can be fooled a lot by our emotions, right? We can be fooled to expect a certain outcome during a recession that doesn't really play out. That slide to show you by Morningstar is a stern kind of reminder that you may feel a certain way of how a recession will play out. And a lot of times it didn't play out like that in history. So that's why we want to, be data focused and not emotions focused. We're doing our best on our side to keep that kind of pledge. And then secondly, making sure that all our clients are invested according to their risk profile, right? We constantly review questions as well as financial plans to make sure that we're at least in something that you are going to have enough dry powder, if you will, for any upcoming cash needs or retirement, those types of things, and making sure, listen, all your portfolio isn't one thing, right? Your portfolio is going to be consisted of stocks and bonds if you're getting closer to retirement. You're going to be relying on those bonds should you be getting closer to retirement and needing that cash, right? That doesn't say that if you've got half of your portfolio still invested in the market, that shouldn't, let's say, be going down. That's more longer term stuff. Let that do what it's going to do for the most part, right? But just make sure we've got enough dry powder to get you through that recession, whether that's 2-3 years worth of dry powder or even more, okay? And that plays into the diversification strategy. And then long term, we really recommend the majority of your long-term assets to stay invested, stay the course. And Austin, I think you can show us why that makes sense.
Yeah, we actually we found a pretty good illustration on that to show you guys today. And when we talk about staying invested, the biggest mistake I think investors tend to make when allowing emotions to drive decisions is to experience a loss and feel like they can't handle it anymore, right? And sell out after the loss has already happened. Okay. And we saw people do that this last year. Like Neil said, we're down 15% from the highs in January of 2022. Market drops 20% and people immediately sell out of their TSP and they move into G fund, right? Because they've experienced the loss and it's too hard to handle any more of that. Well, what would have happened here? So say you invested $10,000 in 2000, right? That's growing, or $100,000, sorry, $100,000 in 2000. It's growing, but then you experience the 08-09 market crash. Well, in 2009, you say, I can't handle this anymore, right? And you sell out of the market. Well, if you waited just 1 year to get back in and you invested back into the market in 2010 after you felt like you were pretty sure the market was headed back the other direction, well, you would have $250,000 less dollars than someone who would have just left their money in the entire time, right? If you move to cash at that point, well, then you're down 700,000, right? Or sorry, 500,000. And so, I mean, this is just one example of the power of leaving your money in if you have that ability. Now, I know someone always has the question, well, I'm 3 years away from retirement, or I'm 70 years old. Maybe I don't have another, 15 years to invest right now. And in that case, what I would say is you need to be in a place where your portfolio is not going to lose 40% if it's down, right? Your allocation needs to be different than this. And that's when it comes into risk calculation, and we can help in that way as well. So just wanted to show that quickly. Now,
and one other thing to just kind of add on that is,
yeah,
what we're doing over the summer is not something where we're planning to ride out for very long, right? So I think I want to make that clear. We did a small tactical move here at the end of April because of the data. The data suggests weaker months ahead, seasonally, and from the economic conditions. So it's not a position we plan to carry for a very long amount of time, okay? By September, October, we plan to unwind kind of that hedge, if you will, on the portfolio by that time. And hopefully we get a little retreat of the market so that bet pays off. But again, it's a small bet. We never are going to promote taking if you're doing this on your own through your TSP, taking your TSP completely out and then trying to put it back in, no way. And this chart essentially shows you why that's a really tough thing to do correctly. So we're doing this on a small hedge, short amount of time, and that's kind of our logic on this. So Austin, you got one last slide there, and I think we're almost done here.
Yep. Yeah, so this is just, if you're a client of ours already, a lot of people on this call are clients of ours, that you can set up a call with us anytime. We're happy to talk about this with you. If you're not a client of ours and you have questions about this, you've been considering working with an advisor, we offer a complimentary financial checkup. So it's a 1 hour call. You get to ask a lot of these questions that you have. We can help review your TSP, review risk allocation, see if there's any tax planning opportunities for you or things you can take advantage of, and really just see if you're on the right track or if there's steps to get you there. So if you're interested in that, you can register here, redfed.com/register, or you can scan that QR code and that will bring you there.